The recent wave of layoffs across various U.S. federal agencies marks a significant restructuring effort under President Donald Trump's administration. The State Department, led by Secretary of State Marco Rubio, has announced a 15% reduction in its U.S. staff and plans to close over 100 bureaus worldwide, citing inefficiencies in its current operations. This move is part of a broader strategy to streamline government functions, which also involves the Environmental Protection Agency, EPA, cutting nearly 300 employees involved in diversity, equity, and inclusion initiatives. The EPA's cuts are part of an effort to dismantle its Office of Environmental Justice and External Civil Rights, reflecting the administration's stance on reducing federal involvement in such initiatives. Additionally, the Health and Human Services Department, under Secretary Robert F. Kennedy, Jr., plans to cut 10,000 jobs, affecting key agencies like the Centers for Disease Control and Prevention and the National Institutes of Health. The Department of Defense is also targeting a significant reduction of 60,000 civilian employees. These layoffs are expected to have wide-reaching impacts, potentially affecting the operational capabilities of these agencies and raising concerns about the implications for public services, including health and defense. The extensive cuts across various departments underscore a major shift in federal policy priorities, focusing on reducing government size and expenditure. But they also raise questions about the potential impact on essential services and federal workforce morale.
U.S. Treasury Secretary Scott Bessent has expressed optimism about a potential de-escalation in the ongoing tariff conflict between the United States and China, describing the current situation as unsustainable. Since President Donald Trump's return to office, the U.S. has imposed a 145% tariff on various Chinese imports, citing issues such as China's alleged role in the fentanyl supply chain and other unfair trade practices. In retaliation, China has levied a 125% counter tariff on U.S. goods. Bessent's remarks made at a J.P. Morgan Chase event have positively influenced market sentiment, with Wall Street indices experiencing a notable uptick. The potential easing of trade tensions between the world's two largest economies is significant, as it could stabilize their strained economic relationship. Bessent highlighted a decrease in container bookings as evidence of the trade strain and emphasized the importance of fair trade, acknowledging that negotiations with China will be challenging. White House Press Secretary Karoline Leavitt also indicated progress towards a potential trade deal, suggesting strategic positioning for negotiations. Meanwhile, the International Monetary Fund, IMF, has warned of the negative impact of these tariffs on the global economy, revising its global growth forecast for 2025 down to 2.8% from the 3.3% recorded in 2024. The IMF has also adjusted the U.S. growth forecast to 1.8% from 2.8%, citing the heightened risk of a full-scale trade war and the unpredictability of future trade policies as significant factors affecting the economic outlook. The IMF's concerns have contributed to increased market volatility and raised questions about the U.S.'s status as a safe haven investment. As these developments unfold, the progress of U.S.-China trade talks remains a focal point at the International Monetary Fund and World Bank's spring meetings in Washington.
The U.S. Department of Education announced that starting next month, federal student loans in default will be referred for collections, affecting approximately 5.3 million borrowers. This move comes after a prolonged pause on such actions since March 2020, a relief measure implemented during the COVID-19 pandemic. With the end of the temporary relief period in October, borrowers in default may face involuntary collection measures such as wage garnishment, tax refund interception, and the seizure of Social Security benefits. These actions are part of the Treasury Department's Offset program, which aims to recover outstanding debts. This development underscores the financial strain faced by many borrowers, as highlighted by individuals like Kat Hanchin, who struggles to meet loan obligations despite being on an income-driven repayment plan. The Education Department advises borrowers to explore options like loan rehabilitation or income-driven repayment plans to manage their debt and avoid the severe consequences of default. the return to collections could significantly impact borrowers' financial stability and credit scores, with delinquencies potentially dropping credit scores by over 100 points, affecting access to credit and housing.
Netflix Inc. NFLX shares are approaching all-time highs following robust first-quarter earnings that exceeded analyst expectations. The streaming giant reported revenue of $10.54 billion and adjusted earnings of $6.61 per share, surpassing estimates of $10.52 billion and $5.74 per share, respectively. This performance was driven by a 13% year-over-year revenue increase. Fueled by membership growth and enhanced pricing strategies, Netflix also provided optimistic guidance for the second quarter, projecting 15% revenue growth and earnings of $7.03 per share, which exceeds current market estimates. Analysts have responded positively, with several raising their price targets for Netflix stock, citing its defensive qualities amid tariff uncertainties and its strategic positioning in the evolving media landscape. The company's limited exposure to global tariffs due to its digital subscription model further bolsters its appeal as a safe haven investment. Additionally, Netflix's ad tier plan is noted for its potential to boost revenue growth, with management confirming stable ad spend despite macroeconomic uncertainties. As Netflix continues to capitalize on the shift away from linear TV, its stock has risen approximately 8% over recent trading sessions, nearing its February high of $1,064.50.
On Tuesday, Wall Street experienced a robust rally, effectively recovering from losses incurred earlier in the week. This rebound saw the S&P 500 rise by 2.5%, while both the Dow Jones Industrial Average and the Nasdaq Composite climbed by 2.7%. The recovery was attributed to the stabilization of the U.S. dollar and steadier Treasury yields, which had previously been volatile due to concerns over President Donald Trump's trade policies and his criticism of the Federal Reserve. Despite these gains, market analysts expect continued volatility, influenced by ongoing trade negotiations and economic indicators. The rally was bolstered by strong earnings reports from several major U.S. companies. Equifax's stock surged 13.8% following a strong quarterly profit report and the announcement of shareholder-friendly initiatives, including a dividend increase and a $3 billion stock buyback plan. Similarly, 3M and PulteGroup reported better-than-expected profits, with their stocks rising significantly. However, RTX faced a 9.8% drop due to a significant profit hit from tariffs, highlighting the mixed impact of trade policies. Conversely, First Solar benefited from the imposition of stricter solar tariffs, with its stock gaining 10.5%. In the broader context, the International Monetary Fund revised its global economic growth forecast down to 2.8%, reflecting uncertainties in international trade dynamics. Meanwhile, Tesla's stock rose 4.6% ahead of its earnings report, despite facing challenges such as a 13% drop in first-quarter car sales. Additionally, gold prices surged to record highs, surpassing $3,500 per ounce, as investors sought safe haven assets amidst market uncertainty. The financial markets continue to navigate these dynamics, with the potential impact of tariffs and geopolitical tensions shaping the economic outlook.
Roche Holdings has announced a significant investment plan of $50 billion in the United States over the next 5 years, aiming to bolster its presence in the country with the creation of over 12,000 jobs. This investment will enhance Roche's existing infrastructure, which already includes 13 manufacturing and 15 R&D sites, by increasing its workforce and expanding its facilities across 8 states. The strategic move is part of Roche's broader effort to increase its export capabilities from the U.S., particularly in its diagnostics division, which already exports more than it imports. This announcement comes amidst a wave of substantial investments by other pharmaceutical giants such as Novartis, Johnson & Johnson, and Eli Lilly, who have also declared multi-billion-dollar plans to expand their U.S. operations. These investments underscore a growing trend among pharmaceutical companies to localize production and strengthen domestic supply chains. This shift could mitigate risks associated with global supply chain disruptions and align with potential regulatory changes under consideration by the U.S. government. The influx of capital and job creation is expected to have a positive impact on local economies and the pharmaceutical sector's growth trajectory in the U.S., potentially influencing market dynamics and investor sentiment in the industry.
Eli Lilly is poised to dominate the obesity market with its promising oral drug, orforglipron, as indicated by Cantor Fitzgerald's recent initiation of coverage with an overweight rating and a price target of $975. The U.S. pharmaceutical giant has reported positive top-line results from its Phase 3 ACHIEVE-1 trial, demonstrating significant A1C reduction in adults with type 2 diabetes. This positions Eli Lilly favorably against competitors like Novo Nordisk, especially if safety and tolerability of the drug hold up. Cantor predicts Eli Lilly could capture over 85% of the obesity market by 2029-2030, leveraging an oral approach that could potentially expand the market and take share from established injectable treatments like semaglutide. Eli Lilly's financial outlook remains robust, with analysts anticipating first-quarter earnings of $4.79 per share on sales of $12.93 billion. The company is expected to reaffirm its FY25 revenue guidance of $59 to $61 billion, with a potential upward revision after Q2 2025. While Eli Lilly predicts a mid to high single-digit price decline by 2025, largely due to its obesity drugs, the company is still viewed favorably by analysts such as BofA Securities, which maintains a buy rating and a $1,000 price target. The recent inclusion of Lilly Direct Vials in IQVIA's prescription data and the launch of Mounjaro in India further underscore the company's strategic moves to strengthen its market position. Eli Lilly's stock is currently trading at $822.84, reflecting a 0.59% increase as investors remain optimistic about its growth trajectory in the obesity market.
Apple Inc. is restructuring its executive team to address delays and challenges in its artificial intelligence AI initiatives, particularly concerning its Siri virtual assistant. CEO Tim Cook has reallocated responsibilities, moving Vision Pro creator Mike Rockwell to oversee Siri, signaling a significant shift in the company's AI strategy. Rockwell, previously leading the Vision Products Group, will now report to software chief Craig Federighi, effectively removing Siri from the purview of AI head John Giannandrea. This strategic move follows an internal announcement and reflects Apple's urgency in revitalizing its AI capabilities, which have been lagging behind competitors. This executive reshuffle highlights the critical situation Apple faces as its AI technology struggles to compete with industry leaders. The Apple Intelligence Platform, intended as a major feature of the iPhone 16, has underperformed, affecting product perception and market competitiveness. The reorganization aims to leverage Rockwell's expertise in product development to enhance Siri's functionality and align it more closely with Apple's broader software strategy. The changes underscore Apple's commitment to addressing its AI shortcomings and suggest a potential pivot in its approach to integrating AI across its product ecosystem. As the company navigates these challenges, the impact on its stock prices and market sentiment will be closely watched by investors.
Power Finance Corporation, PFC, has lodged a complaint with the Economic Offenses Wing, EOW, regarding alleged document fraud by Gensol Engineering, which pertains to delays in debt servicing. The financial irregularities came to light when credit rating agencies Care Ratings and ICRA downgraded Gensol's long-term loans to default status due to ongoing delays in servicing of term loan obligations and overdue payments. PFC clarified that the documents referenced by the rating agencies were not issued by them, signaling potential falsification. The company is conducting an internal investigation under its anti-fraud policy to address these concerns. The situation has significant implications for PFC, a non-banking financial company that had sanctioned a 633 crore loan to Gensol Engineering, primarily for the procurement of electric vehicles for Blue Smart Mobility's ride-hailing service. Out of this, 352 crore was dispersed for leasing 3,000 four-wheelers, with 2,741 vehicles confirmed as delivered. Gensol's financial obligations are backed by various guarantees and liquid assets, yet the invocation of the debt service reserve account to cover recent dues indicates financial strain. This development could affect market sentiment around PFC and its credit risk assessment, while also highlighting the critical importance of stringent due diligence in financial transactions.
Austria's decision to close its hydrogen fueling stations underscores a global economic challenge for hydrogen infrastructure. Despite initial enthusiasm, the high operational costs and low utilization rates have rendered these stations financially unsustainable. Austria's network faced low vehicle numbers and throughput, leading to significant operational losses. The capital-intensive nature of hydrogen stations, with initial costs ranging from $1.5 million to $3 million and annual operating expenses between $300,000 and $500,000, requires a substantial consumer base to break even. However, without a reliable fleet consuming hydrogen, stations struggle to cover costs, leading to closures. California, often seen as a leader in hydrogen adoption, mirrors this struggle. Despite having 74 public stations serving approximately 18,000 vehicles, the average station dispenses only 50 kilograms of hydrogen daily, far below the 200 kilograms needed for profitability. This inefficiency has driven hydrogen prices to $36 per kilogram, making hydrogen vehicles significantly more expensive to operate than electric or gasoline counterparts. Consequently, hydrogen vehicle sales in California plummeted by 85% in 2024, prompting companies like Shell to exit the market. Similar challenges are faced in Germany and Japan, where low vehicle adoption and high operational costs lead to reliance on government subsidies. In contrast, China and South Korea have seen better utilization due to fleet applications, yet profitability remains marginal, heavily dependent on government support. This global scenario highlights the economic hurdles in making hydrogen a viable alternative fuel source without substantial policy intervention and technological advancements.